What's up, you guys? It's Paul here from the 95 Investors Club channel. In this video, I want to talk to you about call debit spreads and put credit spreads. Both of them are pretty much bullish strategies, but I just wanted to explain the differences between them and why you might want to choose one over the other, or if they're both the same. Okay. So to start off, a call debit spread is when you buy a call of a lower strike price and then you sell another call at a higher strike price. And the goal for you to make maximum profit is for the stock to stay above the strike price that you sold. Okay. So for example, Alibaba is trading at 236 right now. Their all-time high was over $300. I think it was over around 317 quite a while back, and back on October 27th, and they've just been falling hard since then. There's been a lot of news about the Chinese government getting into Jack Ma's businesses. Then there was a long time where people couldn't find Jack Ma. And then most recently, Trump came out saying that he's going to ban even Alibaba and Tencent on the US stock exchange. And obviously, I don't think Trump can do that anymore since he's not going to be in power anyway. But thing is, all these various news came together to make Alibaba crash so much. But in reality, as long as nothing drastic like that really happens, I think Alibaba is going to be good and they should be able to get back to all-time highs eventually. So let's say based on that thesis, you expect that by say Feb 19th or so, or basically next month, you expect Alibaba to go back about 250. Here's how you would do that. These are the two options that you have. So you would choose your expiration, which is Feb 19th, just as an example here. Choose Feb 19th. And let's say you wanted to stay above 250 is what your expectation is based on your analysis. You would first want to sell the 250 call, and then as a hedge against it, you would buy the 245 call. And a combination of this is called a call debit spread. Okay. Now the way this would work is you're paying $190 for opening this call debit spread. And as long as BABA stays over 250 by Feb 19th, the value of this spread would be $500, and you would make a profit of $310 per spread that you make. Okay. So if you do the math there, that's about 150% profit, which is pretty solid. But thing is, with spreads, there are always two things that you need to think about. If you let it expire in the money, or where if only one of the calls ends up being in the money and the other one expires worthless, there is always a risk of assignment and exercise that can happen, and you could get assigned to buy 100 shares of BABA, for example, at $245 if BABA for some reason stops at $249 by expiration and you forget to close your spread. Okay, so that's one risk that you have. And the second thing is, even if BABA can go above 250, even if you try to close it before expiration, you may or may not be able to make the full profit of $500. Okay, so more often than not, whenever I get a spread, I end up having to sell it around 475 or 480 instead of 500. So in a way, you're kind of indirectly missing out on that last $20 per spread. Okay, so those are two things that you need to keep in mind when you're trading call debit spreads. But another thing to also remember is, right now your total cost is $190. But to get filled, you may have to keep raising it by $5, and you may actually end up getting filled at $2 instead of $190, and then you may only be able to sell it around $480. So it's in a way reducing your profit potential, but it's still, if you strictly look at it from a percentage point of view, that is still over 100% profit, 125% profit, which is still pretty solid. But if you really want to maximize how much profit that you can make in a spread, a put credit spread might be another alternative. Okay, there are some caveats to it, but I'll explain how that works. So as I mentioned, if you paid $190 for it, your maximum profit is $310, but in reality, depending on where you get filled, your actual profit may only be like $280. Okay, so just keep that number in mind. Now, if you wanted to do a put credit spread, it is the exact same thesis where you're expecting the stock to stay above 250. So in this case, it's the exact same strategy where you're selling the 250 put, which is the price you wanted to stay above, and then you buy the 245 put as a cover, and now you get a credit of 322 instead of having to pay 190. Okay, now when you actually go through the process, let's say I buy one spread, you will still need a $500 collateral, because the maximum loss on this spread is if BABA goes below 245, then the value of this spread would be $500, and so you'll have to pay $500 to close it, and so you end up losing 500 minus 323, which is $177. Okay, so that's why your brokerage will hold that $500 collateral until expiration. But the real difference here is, if you got a credit of 323, more than likely it might be 320, because there's a good chance that each strike can actually moves in increments of $5. So you may get a credit of only 320 instead of 323. But the point is, if BABA can stay above 250, then both the puts will expire worthless and you'll get to keep the full $320 credit. Okay. So in the call debit spread, I told you you may or may not get filled at 190, but assuming you do get filled at 190, you can only close it for 480 or 485, and you'll make about a $300 or a $295 profit. But in this case, you're making $320, and you'll get to keep the full 320 if BABA stays above 250. Okay, so that's the slight advantage that you have with the put credit spread as opposed to a call debit spread. And if this collateral really worries you, just think in terms of the buying power. The buying power only reduces by 500 minus 323 or 320. If it gets filled at 320, that's still 180. Whether you got a call debit spread or a put credit spread, your buying power is actually reducing by about the same amount. Okay, so that's the real advantage with put credit spread. Actually, one of our Discord members, White Devil, he's the one who actually figured this out and suggested that in the Discord group. So thanks for pointing that out. I appreciate that. But definitely keep this in mind. You might find this pretty helpful. Same thing with the call debit spread. It may not get filled at 190. You may have to fill it at 200, for example. So same thing with the put credit spread. You may not get 320. You may get 310 instead. But either way, you may end up making an extra $10 or $20 by going for a put credit spread. And as long as it stays above 250, it can expire worthless, and you don't even have to worry about closing it. Okay. Now, the only risk you do have is similar to the call debit spread. If it falls to say 249, the put that you bought will expire worthless, but the put that you sold, the 250 put, will have a value of $1. So if BABA looks like it's going to stay below 250, you're better off paying a small amount, say $50 or $100, to actually close it, and that way your actual profit would be 320 minus 50 or 100 that you pay, which would end up still being about a $300 or $200 or $250 profit. Okay, so just keep that in mind. Those are the two risks that you would face if it stays below 250. Either way, I always typically recommend that you close out of a spread before expiration and not run the risk of getting assigned or having some kind of a huge move after hours that can put you in trouble. So always make sure that you close your spread before expiration. Okay. Now, having said that, I also wanted to share some of the stocks that I'm watching for you guys just for next week. A couple of trades that I shared with my Discord members was on UVXY. The market is back at all-time highs as if nothing has happened. It's perfectly understandable because there were so many catalysts to push it up, which is the fact that there was no more uncertainty regarding elections, no more uncertainty regarding the stimulus. We already have a vaccine out. Sure, there's a lot of chaos at the White House, and people are still expecting something crazy might happen on actual inauguration day, so that will add a lot more volatility too. But the reason the stock market is back at all-time highs is because everyone is under the impression that things should be smooth from here because the Democrats control the House and the Senate right now, and with the Democrats winning the Georgia Senate runoff recently, in that way people are expecting things to be pretty smooth. And if stock market is at all-time highs, then UVXY, which is the volatility index, started going down, is pretty much back at all-time lows. Okay. If the market keeps pushing up, obviously UVXY will continue dropping. It does decay at a pretty decent rate as long as market keeps shooting up. But just in case there is a correction over the next couple of months, I decided to get two of these June 18th $11 calls on UVXY. And the whole point of getting this is I actually don't mind if they expire worthless, because if this expires worthless, it means the market is still at all-time highs, is continuously pushing upwards, and that means that my stocks and call options are doing well on the other hand. So I don't really mind if UVXY expires worthless. The whole point is that it's just a hedge, where if we do have a sharp correction, which we typically do at least once a year, about a 7 to 10% correction, or maybe even more. And when that does happen, UVXY is going to spike a lot, and we can take advantage of these calls to take a profit during that time. Okay, so that would be the perfect opportunity where you take a profit on this, and then you can reinvest those profits to buy calls on the stocks that got potentially destroyed during that correction. Okay, now on top of UXY, I also got some calls on SQQQ. Now this is like the inverse exposure to NASDAQ, where if NASDAQ crashes, SQQQ shoots up, and vice versa. So similar to UVXY, which is like inverse S&P 500. I got calls on SQQQ for June as well. I got 3 of the $18 calls. Again, same thing. If this loses a lot of value, I don't really care about it. It's down 10% already. But whenever NASDAQ does crash, which I do think it might over the next couple of months, then these calls should shoot up a lot, and you're essentially hedging against the market without taking too much risk. Okay. Another alternative, if you don't want to play UVXY or SQQQ, is just to get SPY puts, for example. That's an alternative too. But my point is, have a very small portion of your portfolio in it, just as a hedge against the market, because we are at all-time highs. And even if it expires worthless, just assume that it doesn't really matter, because if these expire worthless, then your other stocks are actually doing really well. Okay. And other than the volatility indexes, some of the other stocks that I'm watching are like Roku. Roku is acquiring Quibi's content, so that's why they shot up like crazy over the last 1 week, up 17%. Even on Friday, they were struggling to shoot past $400 several times. They just kept bouncing off of it several times during the day. We had a bit of a pullback, then it recovered, and again struggled to cross 400 again. But I'm really looking to see if it can cross 400 next week. Hopefully, I'm just owning shares for now, and so I'm pretty happy with it either way. But definitely watch out for Roku. Trade Desk corrected a lot. They were at an all-time high of $970, and they've corrected pretty decent bit from 971 to around 800. So I think Trade Desk can recover too. Definitely watching that. Magnite had a short seller news report come out where they think it's currently overvalued, so it dropped 17% in the last 1 week. I picked up some June $40 calls on Magnite. I'm still holding them for now, and obviously I have 500 shares as well. I think Magnite still can do really well in the long term. I'm actually really happy about this pullback, because they've shot up so much in just the last 3 months, over 200%, that it was hard to either pick up more shares or even get calls on it, because they were at all-time highs with no correction whatsoever. So this is actually a blessing in disguise and a great buying opportunity in my opinion. Okay. A couple other stocks that I'm watching are PayPal. PayPal is pretty much back at all-time highs now, back around 243. I want to see if they can break out from here at 243, or if they actually pull back after bouncing off of the previous all-time high. Same thing with Square as well. Square also has been shooting up like crazy, and they're back at all-time highs here around 241, 242. I want to see if they can break out as well. We are indirectly playing it anyway. I got these calls on ARKK, for example. Square is a big component of ARKK, so I have 2 of these 152.96 calls for June. They're up a pretty decent amount, about 109% in just about 2 weeks now. So that's pretty decent. So I'm definitely watching out for ARKK. I still think they are going to be one of the best performing ETFs in 2021 as well, barring a major correction in the market, of course. The Clover or IPOC merger got confirmed, so now we are starting to trade under the ticker symbol CLOV instead of IPOC. We saw a bit of correction in that. If Open Door is like a preview, and Open Door crashed so much right after the merger, we may see a pullback in Clover, so I'm definitely watching out for that. We can't trade options on it yet, so I'm just holding my 125 shares. But if we do see a pullback, then it would be a great time to get in more, especially if they fall below $15. Okay, so definitely watch out for it. If they keep shooting up, it's still okay because we have shares, but definitely add that to your watch list. Okay, so that's all I wanted to share with you guys here today. I hope that helps you out. If you have any questions, please feel free to leave a comment below. If you enjoyed the video, please just smash that like button and subscribe if you haven't already, and hit that notification bell. Okay, thanks again for watching, and until next time.